2024 changed everything for decentralized exchanges. Memecoins exploded, AI trading bots took over, and Solana versus Ethereum became the biggest battle in crypto. Retail traders are making life-changing gains while institutions are quietly stacking liquidity on Ethereum. But with DEX trading volume hitting all-time highs, the real question is, where is all of this heading? Welcome to the ChainPoint channel. In this video, we're diving into the 2025 OKX DEX report, breaking down the biggest trends shaping the future of crypto markets. From Solana's Memecoin mania to Ethereum's fight for institutional dominance, we'll explore how liquidity wars, AI trading, and on-chain derivatives are redefining decentralized finance. Let's take a look. But before we continue our talk, don't forget to hit the subscribe button to stay tuned to what is happening in the crypto world. And remember, everything we say here is not investment advice. Always invest wisely. Let's get started. In 2024, decentralized exchanges, DEX, experienced an unprecedented explosion in trading activity, fueled by the rise of Memecoin speculation. Retail traders flocked to on-chain platforms, chasing massive gains on viral tokens, pushing blockchain total value locked, TVL, to new highs. With centralized exchanges tightening regulations and imposing restrictions, traders sought alternative avenues where they could trade permissionlessly, leading to a shift towards self-custody solutions. Solana, in particular, became the epicenter of Memecoin trading, with platforms like Pump Fund enabling rapid token creation and speculation. Over 103,000 tokens graduated to Radium after reaching market cap thresholds, proving how retail enthusiasm could drive liquidity surges. Ethereum and its Layer 2s, on the other hand, maintained dominance in institutional-grade liquidity, processing over 64% of large trades, $50,000 plus, highlighting the divide between speculative retail and deep liquidity markets. But with this parabolic growth came challenges. Solana's liquidity became fragmented, spread across thousands of small pools, each seeded with an average of $177,000. While this allowed for quick token launches and high trading velocity, it also introduced high slippage and volatility, making large-scale trades difficult. Meanwhile, Ethereum continued to solidify its reputation as the go-to chain for whales and institutional players, leveraging its robust DeFi ecosystem and deep liquidity pools. This dynamic shift between high-risk, high-reward retail trading on Solana and institutional capital dominance on Ethereum set the stage for what many now call the liquidity wars, a battle between chains, traders, and protocols fighting for capital. As DEXs continue to evolve, OKX's 2025 report sheds light on the major trends shaping the industry. The report highlights how liquidity fragmentation, Memecoin speculation, and AI-powered trading are driving new innovations and challenges in the space. With the DEX to CCAC spot trading ratio reaching an all-time high, it's clear that decentralized platforms are no longer niche alternatives, but key players in global crypto markets. One of the biggest takeaways from the report is the rise of chain-specific optimizations. Platforms like DYDX and Hyperliquid have launched their own sovereign blockchains, processing up to 20,000 transactions per second, rivaling centralized exchanges like Binance. This move allows for faster trading execution, reduced fees, and deeper liquidity aggregation, making DEXs more competitive in high-frequency trading. Meanwhile, Ethereum's Layer 2 continued to attract institutional traders, solidifying Ethereum's position as the DeFi stronghold. Another key focus is the Memecoin phenomenon, particularly on Solana. The report notes that 60% of Solana's DEX volume is driven by Memecoin speculation, with Pump Fund emerging as a retail trading hub. While this creates a vibrant market, it also introduces liquidity fragmentation as short-lived assets constantly rotate. In contrast, Ethereum remains dominant in large-scale liquidity pools, with only one of the top 20 DeFi liquidity pools belonging to Solana. The future of DEXs, according to the report, hinges on balancing speed, security, and capital efficiency. AI-powered market makers, improved liquidity aggregation, and cross-chain interoperability will play crucial roles in shaping the next generation of decentralized finance. But with Ethereum and Solana taking radically different approaches, which model will define the next era of trading? The battle between Ethereum and Solana is heating up, with both chains fighting for dominance in on-chain trading. Solana's ultra-low fees and high-speed transactions have attracted retail traders, fueling a Memecoin-driven trading frenzy. Meanwhile, Ethereum, with its deep liquidity and institutional presence, remains the preferred choice for high-value transactions and long-term DeFi strategies. Solana has established itself as the retail chain, processing thousands of trades per second with minimal transaction costs. This accessibility has made it the go-to network for Memecoin speculators, with Pump Fund alone accounting for a massive share of its trading activity. However, liquidity fragmentation remains a concern, as capital is spread across thousands of small pools, creating challenges for large-scale traders looking for stability. Ethereum, on the other hand, has maintained its dominance in institutional liquidity, with 64% of large DEX trades still taking place on Ethereum. The network remains the stronghold for whales, DeFi protocols, and professional market makers. Its Layer 2 solutions like Arbitrum and Base have further optimized trading efficiency, offering lower fees while preserving Ethereum's security and composability. So, what does the future hold? While Solana dominates in retail-driven, high-velocity trading, Ethereum is positioning itself as the institutional powerhouse of DeFi. The real question is, will Solana's explosive growth in speculative trading translate into long-term sustainability, or will Ethereum's deep liquidity continue to secure its place as the king of decentralized finance? In 2024, Memecoins became the driving force behind Solana's unprecedented growth in DEX trading volume. Unlike past cycles where speculative tokens thrived on Ethereum, this time Solana emerged as the ultimate playground for high-risk, high-reward trading. With 60% of Solana's DEX volume fueled by Memecoins, it's clear that retail traders have found their home on the network. A major catalyst for this surge is Pump Fund, a platform that enabled over 103,000 tokens to reach market cap thresholds, qualifying them for listing on Radium. This fast-paced, open-access environment turned Solana into a degens paradise where anyone could create, launch, and speculate on new tokens within minutes. The rapid trading volume pushed Solana's blockchain TVL past $1 billion, solidifying its status as the top chain for speculative retail activity. However, Memecoin-driven liquidity is highly unstable. Unlike Ethereum's DeFi-heavy ecosystem, where liquidity pools have long-term sustainability, Solana's pools are often short-lived and rotational. The average new liquidity pool is seeded with around $177,000, but with thousands of pools competing for capital, slippage remains high, making large trades risky. This liquidity fragmentation creates challenges for traders looking for stable markets and deeper order books. The Ethereum 2 upgrade and scalability solutions have further positioned the network as the go-to choice for institutional investors. With only one of the top 20 largest liquidity pools belonging to Solana, Ethereum still holds the strongest DeFi infrastructure, allowing for efficient capital allocation, yield generation, and institutional DeFi strategies. Ultimately, Ethereum's role as the institutional backbone of DeFi seems unshakable, but as Solana continues to attract high-volume traders, will Ethereum adapt and evolve to maintain its dominance, or will the shift toward faster, lower-cost chains force it to rethink its approach? One of the biggest challenges facing Solana's DEX ecosystem is liquidity fragmentation. While the network has seen explosive growth in memecoin speculation and high-frequency trading, its liquidity is spread across thousands of small, short-lived pools, making large-scale trades inefficient. Unlike Ethereum, where deep liquidity pools ensure lower slippage, Solana's fragmented liquidity structure creates unstable market conditions for traders. A key issue is the lack of sustained capital concentration. On Solana, each new liquidity pool is typically seeded with around $177,000, but due to rapid rotations in trading volume, these pools often lack depth. As a result, high-value traders struggle to execute large orders without suffering from significant price impact, leading to a preference for Ethereum and its institutional-grade liquidity. This fragmentation also affects market efficiency. With so many small pools competing for liquidity, price discrepancies between DEXs increase, making arbitrage opportunities more frequent but harder to capture at scale. Meanwhile, Ethereum's Layer 2 networks help consolidate liquidity while still offering low fees and high transaction speeds, reinforcing its position as the preferred chain for deep liquidity trading. Without better liquidity aggregation, the divide between Solana's retail-driven markets and Ethereum's institutional capital stronghold will only continue to grow. While spot trading dominates DEXs, the next frontier of DeFi is the rise of on-chain derivatives. Platforms like GMX, DYDX, and Hyperliquid are leading the charge, introducing high-speed app chains that rival centralized exchanges in performance. With derivatives volume historically outpacing spot trading in traditional markets, it's only a matter of time before on-chain derivatives overtake spot DEXs as the primary trading venue for professional traders. A major game changer has been the launch of sovereign app chains. DYDX's move to a Cosmos-based blockchain allowed it to process 2,000 transactions per second, pushing its daily trading volume past $1 billion. Similarly, Hyperliquid's custom-built Layer 1 achieved a staggering 20,000 TPS, enabling it to handle up to $19 billion in 24-hour trading volume without stability issues. These performance improvements are closing the gap between DEXs and CEXs, making decentralized derivatives a serious contender in the trading space. However, liquidity remains a critical challenge. Unlike centralized exchanges, where all liquidity is concentrated in a single platform, on-chain derivatives markets face fragmentation across different chains and protocols. Some projects, like Elixir, are working on unified liquidity pools to aggregate capital. The rise of derivatives DEXs marks a fundamental shift in DeFi's evolution. As more capital flows into perpetuals, options, and structured products, the battle between spot and derivatives markets will define the next phase of decentralized finance. The rise of AI-powered trading agents is reshaping on-chain finance, bringing a new level of automation and efficiency to DeFi markets. Platforms like Virtual's Protocol have already launched over 11,500 AI agents, executing real-time arbitrage, market-making, and liquidation strategies across decentralized exchanges. With AI's ability to analyze vast amounts of data and react faster than human traders, the DeFi landscape is evolving rapidly. AI-driven strategies are particularly effective in high-frequency trading environments like Solana's Memecoin markets, where price movements are volatile and unpredictable. These bots can scan liquidity pools, detect inefficiencies, and execute trades in milliseconds, making them a powerful tool for both individual traders and institutional market makers. As a result, AI trading is becoming a key driver of volume on fast-moving decentralized exchanges. However, the integration of AI into DeFi isn't without challenges. As AI agents become more sophisticated, the risk of market manipulation, front-running, and unforeseen exploits increases. AI-driven liquidation bots have already demonstrated the ability to instantly react to margin calls, forcing cascading sell-offs and leverage positions. If you want to dive deeper into how AI agents are changing crypto trading, check out our video, Top 4 AI Agents That Could Transform Your Crypto Portfolio, where we break down the most powerful AI trading bots and how they can be used to maximize your crypto gains. As AI-powered trading agents take over DeFi, security risks are becoming a major concern. While AI can execute trades at superhuman speeds, it also introduces new attack vectors, including rogue AI behavior, protocol exploits, and algorithmic manipulation. The more autonomous these bots become, the higher the risk of unintended consequences in decentralized markets. One major concern is AI-driven exploits. Malicious actors can program AI agents to scan for vulnerabilities in smart contracts, execute flash loan attacks, or exploit liquidity pools within seconds. This type of automated hacking could trigger massive losses before human developers even detect the breach. As DeFi protocols race to integrate AI, they must also prioritize security measures to prevent AI from being used as a weapon against the market. Another issue is AI market manipulation. With high-frequency trading bots dominating DEXs, there's a growing fear that AI could artificially inflate prices, front-run retail traders, or create fake buy-sell signals. These tactics, already common in centralized finance, could become even more dangerous in permissionless on-chain environments where AI is free to operate without oversight. The crypto market is evolving, with Ethereum and Solana emerging as two distinct powerhouses. Ethereum is becoming the institutional chain, favored by whales, DeFi protocols, and long-term investors, while Solana thrives as the retail-driven, high-risk, high-reward trading ecosystem. This divergence is shaping the next phase of decentralized finance, forcing traders to choose between stability and speculation. Ethereum's strength lies in its deep liquidity and institutional-grade security. With only one of the top 20 largest liquidity pools belonging to Solana, Ethereum continues to be the go-to network for large-scale transactions. Meanwhile, its Layer 2 expansion is making trading cheaper and faster, reinforcing its dominance in DeFi. For serious investors, Ethereum offers a safer, more predictable environment for capital deployment. Solana, on the other hand, thrives on speed, low fees, and relentless speculation. With Memecoins driving 60% of its DEX volume, it has become the ultimate playground for traders chasing 100x gains. However, liquidity fragmentation, short-lived pools, and high slippage present challenges for traders looking for long-term market stability. Still, Solana's rapid adoption in retail trading proves that high-frequency, high-risk markets are here to stay. We've just explored the biggest trends shaping the next era of decentralized trading, from Memecoins fueling Solana's growth to Ethereum's institutional stronghold and the rise of AI-powered trading bots. But here's the real question: where do you think the future of DeFi is headed? Will Solana's high-speed, high-risk trading keep dominating, or will Ethereum's deep liquidity and institutional adoption secure its place at the top? Let me know in the comments. If you found this breakdown valuable, smash that like button, subscribe for more in-depth crypto insights, and hit the notification bell so you never miss an update. Thanks for watching this, and I'll see you in the next video.